Each recession, and I've lived through, and I've seen this movie many times before, has its own personality. This one's unique. It's very hard to contemplate a recession at full employment, yet that's what we have. In my portfolio of companies, private, all of them, about 56 of them, they're across all 11 sectors of the S&P in almost every geography in the US. We see the tear sheets for revenue and cash flow on a very orderly basis, often once a week. And here's the challenge for any small business right now. So full employment, we haven't seen a slowdown in consumer demand. And at the same time, you're watching all this doom and gloom, and I see it too, and so do the CEOs of these companies, and their decision, the hard part of all this is what to do about inventory going into holiday and Q1. Do you pull back because you think this recession is going to hit us in Q4, which we're basically in right now, and holiday's coming up in a few weeks, extended holiday this year by over 3 days, which if you're doing 200 million or 150 million in sales, a lot of inventory. And so you're trying to gauge the pessimism out there as the stock market tries to forecast the future in 2023. Meanwhile, your sales are humming. So do you want to leave anything on the table? And more of a perplexing situation coming out of the pandemic is most of these companies have gone past 50% direct-to-consumer models. Big, succulent margins, direct-to-consumer, bypassing retail. Advertising digitally, acquiring customers economically. They know their CAC, they know their subscription services, they know the attrition rates, they're making money, and if they sell product online that they don't have to ship, well, you should burn in hell in perpetuity for that. And so, that's basically the challenge that most small businesses have. There is no evidence of a recession yet clearly the market is telling you it's coming. You just don't know when. Last speculation I'll make, the reason this is happening is we printed $6.7 trillion basically for free in 30 months, and then we say, oh, there's inflation. Well, no shit, there's inflation, because extra cash chasing fewer goods creates higher prices, which is what's happened. But all that cash is still sloshing around, which is why the consumer's not dead yet. That's my 2 cents. There has been a change in investor sentiment regarding investing in small business, and here's what it is. Because of what occurred during the pandemic, this remarkable digital pivot, I call it, America 2.0, where companies that pre-pandemic, if you look at the pie chart of revenue, it would have been 50% through retail, 40% through Amazon, just another retailer, except you don't get the data from them, 10% your own website. That's completely changed. The successful companies that went through the pandemic, even Amazon went to essential goods only, if you remember, in February, March, April, and May of 2020. So those companies had to build out their own platforms and start acquiring customers. So if you look for an A round or a B round or a C round in a small business now, and you go to the investor community and say, look, I'm looking for money, the first question every investor's analyst asks you, and we're no different, do you know your CAC, your customer acquisition cost? Do you know your attrition rate of customers? Do you know the lifetime value of that customer? And are you now past 50% direct to consumer? Because when you get past 50% direct to consumer, you get something more valuable than anything. You get data, your own data, size, preference, flavor, frequency of purchase, price point, regional disparities on flavors and all kinds of sizes, and differences in people's preference. Just say the wine business, for example, what people drink in Florida is completely different than what they drink in Ohio. And if you're selling direct, which you can to 42 states now, you have that data. And that data is priceless. It's the new oil. Data's the new oil. So if your company can't analyze data, you're not collecting data, you don't even understand what I'm talking about, no chance in hell you're getting an investment. You're just going to go out of business because your competitors are so much better than you. That's what's different in the last 2 years. Data. Companies that know how to mine data and understand it, because that's the first thing we ask. If you understand your CAC, I can pour $4, $5, $6 million onto it and grow the business dramatically because we already know I'm just pouring gasoline on the fire. If you don't know, we don't even read the deck. If I look at a company and they're spending 12 to 18% of their income statement on marketing, essentially, I want to know what the return of that is. And so to me, that is measured by customer acquisition cost, because I don't care who you are, what you sell. It's as you said, Rustam, that it's about digital. I mean, every business that's successful, even Nike, a giant behemoth, during the pandemic, they claimed it was going to take them 6 years to get to 50% direct consumer in all geographies. They did it in 5 months. And as a result, survived the pandemic at much higher margins and free cash flow because the only costs you have if you're direct to consumer is manufacturing, logistics of shipping, and customer acquisition costs. That's it. Now, if you have that situation, you're bypassing the traditional distribution, saving 40%, and that goes right back into the business. So for me, it's if you're spending money on marketing, are you constantly experimenting with new ideas? So I've always said to my companies, I want a third of marketing to be experimental every quarter. Because if you're just sitting on your laurels doing the same old crap, you're missing out and your competitors are going to do something else. So start experimenting, because the value of something that works, that you find through just creative chaos, is extremely higher than what you've already been doing, because you start losing yields right away. Whatever your strategy is, and let's say you're getting a 2% response on it, watch, 6 months from now it'll be 1.7 or 1.5. What's the next thing? What's the next idea? What's the next drop? What's new? Because it's so noisy out there, as you all know, you've got to keep creating, and everybody has the tools to do that. Obviously, yields are way down from 2 years ago because of what Apple did on privacy, but that doesn't mean you can't fix it by smashing data together. If you're using Meta, you can buy other services that target your customers in various geographies, and we do that a lot. And I'm shamelessly promoting them, but I'm using C² Social in a lot of my companies now because they're small, they're entrepreneurial, and I'm a paid spokesperson. It's true, but it's because I eat my own cooking. I spend money on them to get my yields up on Meta, and I do. Let's say you've lost 28% of your yield because of Apple, which is approximately what you lost. You can get back half of that when you start smashing data from other sources, including yours. I mean, there's data out there the credit card companies and banks have that help you do this. Now, if you don't know what I'm talking about, you're screwed anyways. This is a standard procedure right now in terms of putting together good campaigns. I teach a lot of graduating cohorts of engineers. I always go to the graduating cohort because a third of the class is very entrepreneurial and they do deals, and I get to see them before the VCs see them. So I'm doing this on a selfish basis, but it really works. There's a use case I want to show you. Payment systems are so brutally competitive in fintech, it's impossible. Let's take a use case of a credit card. The chance that you could launch a credit card in this market, in my mind as an investor, 0 probability of success, because you'll never acquire customers. Here's one, built. This is a MasterCard. What this guy did, first time I've ever invested, I own a piece of this company, he came to me and said, I'm going to use community. I'm going to go to every renter in America and let them pay their rent on a credit card. How crazy is that idea? Because I said, it'll never happen. You can't shave 3% out of a landlord. He said, no, the landlords pay nothing. We're going to make this work for the landlords and make our money on all the other things people do with this card. There he had a plan to go to a community and use social media to say, you pay rent, you want to increase your credit score? Use Built. This thing is the fastest growing card in America. His CAC is low because if you rent, you want this. I knew it was going to work when my daughter and son called me and said, there's a waiting list. You got to call the guy up. You're an owner. I need the card. They were screaming to get their rent paid on it because it's $2,000, $3,000, $4,000 a month that they're getting credit for. Brilliant, brilliant idea. That's using community. That's using social media. That's a payment system. But the key there is he figured out CAC. Everybody else that's trying to launch credit cards goes to 0 almost immediately. They can't compete with MasterCard, American Express, Visa. It's impossible to gain share against those guys unless you're in bed with them and you have a different approach, which is what Built did. That's innovation. That's entrepreneurship. And boy, does that guy spend on social media. He's insane because he knows his CAC. He can pour gasoline on it. When I invested in it, it was a $5 million valuation. We just did another round of $1.5 billion. That was 18 months ago. That's what I'm talking about here. That's innovation in payments.